The date of today is an important date. And the reason that's important is just yesterday at Davos, Switzerland, the IMF stood up and said the world economy is hitting into the worst economic headwinds since World War II, the worst. And that's why it could be bad news, but depending on how you look at it, it could be very good news.
This is about as macro an environment as I've ever seen. And I think most people's read on it is probably wrong right now. I'm going to take you through a history lesson.
Good.
And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. And that period was fascinating because interest rates went up. And the first thing that happened was the economy went straight back into recession and inflation went negative. Because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. So we went back into recession, and then eventually some better times. And I'll come back into the 1940s and 50s because I think it's a really important parallel that most people misunderstand. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of these oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up, inflation shot up, and the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%, and the ISM survey, which is a good guide to the business cycle, anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months, based on exactly the same kind of setup we've got now.
So you're saying that the 70s are now pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Then the next one up is 1984. We saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy. So then the next time we see something similar was 2008. If you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet, and what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens is that consumption falls because we've tightened monetary conditions. So tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1-year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021 and the rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff, and then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. And it's suggesting that if we're not careful, we could have a very sharp nasty recession, meaning kind of a negative 5% GDP recession. It might be short, depending what the Fed does, and we'll come on to that in a bit. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough, so their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. Okay, this is not good. But the answer to higher prices is higher prices. And that's what's happened. And everybody's looking around themselves saying, well, what's going to break? When stuff like this happens, the market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken. And the Fed are going to have to pivot.
And that's what the IMF is saying in Davos yesterday.
They're saying, and it's dead right, the monetary conditions that we've imposed on corporates and people is the biggest tightening in all history. We've also got China slowing down very fast because the lockdowns, but also they've been in recession, and Europe with a war and having to deal with this energy transition. So we've got no leg of global growth here. Now, the question is, how bad does this get? Let's talk some scenarios.
When people use the word recession, that means 2 back-to-back quarters of negative growth.
That's the technical definition of a recession. To you and me, I think it means a loss of jobs and a loss in your net worth because it's the falling of asset prices that comes with a recession.
What's the possibility of sliding to a depression?
So depression, I would suggest, is a much longer, more extended period. I don't think that can happen right now. Now, I don't say that with certainty. I never do. Talking probabilities. The reason being is there's one piece of magic, the Fed balance sheet. The Fed balance sheet disguises all bad things because what it does is when they print money, it lowers the purchasing power of the dollar. And most of the central banks at the same time do it. And people always think it's going to be inflation is what it leads to. It leads to something much more pernicious and evil, which is the debasement of currency. And what that does, how it manifests itself, is all of these scarce assets, equities, real estate, gold, crypto, go up a lot. But all they're doing is reflecting the devaluation of the fiat currency itself. So that optically can change everything because suddenly all of these things go up, everybody feels okay, and it changes the outcome. People are still worse off, generally.